You've probably heard of cryptocurrency before. If not, you might recognize names like Bitcoin, Ethereum, Solana, or Dogecoin. Or maybe not. There are lots of people who are confused about crypto. These are all types of cryptocurrencies. Many people buy them as investments, hoping their value will increase over time so they'll make money. Others use them more like money to buy and sell things. Cryptocurrency prices have been a roller coaster. Some people have made a ton of money, while others have lost big time. This wild ride has made crypto exciting for some, but it's also left others feeling pretty unsure about the whole thing. So, what exactly is cryptocurrency? How does it work? And what do terms like blockchain and mining mean? In this video, we'll break down everything you need to know about cryptocurrency and how it works in simple, easy-to-understand terms. Cryptocurrency is like digital cash that you can send, receive, and use to buy stuff, just like regular money. The word cryptocurrency comes from crypto, codes for safety, and currency, money. Cryptocurrencies only exist online and don't have a physical form. Those are just symbols. You might be wondering, what's the difference between cryptocurrency and the money in my bank account? Traditional currencies like the US dollar and euro are controlled by central banks. But with cryptocurrency, you can send money directly to someone without needing a bank. Cryptocurrency was made to be free from the government's control. This idea started with Bitcoin, created in 2009 by Satoshi Nakamoto. Unlike regular currencies, cryptocurrency lets people exchange money directly. This change aimed to give financial power to individuals. Is cryptocurrency really money or more like an investment? It was meant to be used like money, but now it's more like an investment. Most people buy it to make a profit. Its price changes quickly, making it unreliable for daily use. So people treat it as an investment instead. Cryptocurrency started with Bitcoin, but now there are many others like Ethereum, Tether, and even meme coins. Cryptocurrency works using a technology called blockchain. What exactly is a blockchain? Imagine Sam has a notebook where he writes down every transaction. Once he writes a transaction down, it's locked in and can't be erased or changed. Now imagine that everyone in a blockchain network has an identical copy of Sam's notebook. This way, no one can cheat or change past transactions that were written down. If Sam tries to hack his own notebook and change something, it will be obvious because his copy won't match everyone else's, making it invalid. Each page in the notebook represents a block in the blockchain, and when a page is full, a new one is added to the chain. That's why it's called a blockchain, a chain of blocks that stores transaction data securely. So, how does cryptocurrency use blockchain technology? When someone makes a transaction, the details are sent to a network of computers all over the world that are part of the blockchain. These computers check if the transaction is valid by solving a complex puzzle or equation. Once they solve the puzzle and confirm the transaction is correct, the information is added to several blocks in the blockchain. These blocks are linked together, making the data permanent and unchangeable. Once that's done, the transaction is complete. With regular money, like US dollars or euros, a bank verifies and processes transactions. But with cryptocurrency, these worldwide computers do the job by solving difficult puzzles and equations. Now, you might be wondering, who are these people on computers solving the puzzles? The people who run them are called miners. But why do they do this work? When they solve a puzzle and confirm a transaction, they are rewarded with cryptocurrency coins. This process is called mining and is based on a system called proof of work. That's why you may have heard about Bitcoin miners using powerful computers. They're trying to solve as many puzzles as possible to earn more cryptocurrency. However, not all cryptocurrencies are mined this way. Some, like Ethereum now, use a different method called proof of stake, which is for another video. So now you know that cryptocurrency transactions are verified by computers and recorded in a blockchain, making them secure and unchangeable. But once you own cryptocurrency, how do you store or use it? Let's find out. To store cryptocurrency, you need something called a crypto wallet. Unlike a regular wallet that holds cash, a crypto wallet stores private keys, which are like passwords that give you access to your cryptocurrency. There are two main types of crypto wallets. Hot wallets. These are connected to the internet, making them easy to use but also more at risk of hacking. Examples include mobile apps and web wallets like MetaMask or Trust Wallet. Cold wallets. These are offline physical data storage, making them much safer from hackers. Cold wallets include hardware devices like Ledger or Trezor, where your private keys are stored on a physical device. If you lose your private key, you lose access to your cryptocurrency, so keeping your wallet secure is extremely important. One guy had his wife accidentally throw his away, and several years later he's still going to the dump looking for it. Now, How do you actually use cryptocurrency? There are several ways: trading and investing. Many people buy and hold cryptocurrency, hoping its value will go up over time. Others trade it often to take advantage of price changes, just like with the regular stock market. Purchases. Some businesses accept cryptocurrency as payment. Sending money. You can send cryptocurrency to anyone in the world instantly, often with lower fees than banks or money transfer services. Decentralized finance, or DeFi, is a growing sector where some platforms allow you to lend, borrow, or earn interest on your cryptocurrency without needing a traditional bank. It's pretty revolutionary, don't you think? While cryptocurrency has many benefits, it also comes with its share of risks. Prices can change quickly, going up or down in a short time. This makes investing in cryptocurrency risky because you can lose money just as fast as you can make it. It's something to keep in mind, especially if you're being more risky with short-term buying and selling. The stakes are higher, and the potential for loss is greater, so be cautious. Security is another concern. Since cryptocurrency transactions can't be reversed, if you send money to the wrong address or fall for a scam, you won't be able to get it back. Scams, hacks, and fraud are common in the crypto world, so it's important to be careful and make sure you're dealing with a reputable company. Regulation is also a big issue. Governments around the world are still deciding how to handle cryptocurrency. Some countries support it, while others have banned or restricted its use. Because of this, the future of cryptocurrency is uncertain. However, the President of the United States has recently stated that he wants the United States to be the leader in cryptocurrency. So that's a sign that it may be going strong for quite some time. Even with the challenges, many people believe that cryptocurrency and blockchain technology have a bright future. Some think cryptocurrency could become a common way to pay for things, while others believe blockchain could improve industries beyond finance like healthcare and supply chain management. So cryptocurrency, which is basically digital money, uses blockchain technology to make sure transactions are safe and secure without needing banks or middlemen. This means transactions are super fast, and there's a chance to make some serious profit. But be careful, because the prices can be unpredictable and there are still some security risks involved. Now that you know what cryptocurrency is and how it works, will you be trying crypto? Let us know in the comments. See you next time.